Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Dragonfly Energy.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. When we look at Dragonfly Energy, you really have to frame the story here. It's not one of slow and steady progress.
Not at all.
It's more a story of, well, corporate survival, followed by this massive, really aggressive transformation. We're talking about a company that made a huge pivot to de-risk its balance sheet.
And that pivot was so critical because, frankly, they were under a ton of pressure. I mean, for you listening, the first big hurdle they cleared was just getting back into compliance with Nasdaq. That was back in, what, October, November of 2025. Getting that minimum bid price and market value sorted out.
Exactly. And meeting those minimums, it might sound kind of procedural, but when your stock is bumping along the bottom, that compliance fight, it's a huge psychological barrier for any new serious investor.
Sure.
Clearing that shows stability. It gets rid of this existential threat that was just hanging over the company.
But just being compliant doesn't fix a broken balance sheet, right?
Yeah.
The real game changer, and this happened fast, was the cash injection.
Oh, absolutely.
Since July 2025, they've pulled in something like $90 million in gross proceeds through public offerings.
Yeah.
I think management themselves called it transformative.
And they weren't exaggerating. But this is where the analysis has to go a bit deeper than that headline number. It's not just that they raised the money, it's what they did with it immediately.
They went straight for the debt.
Straight for the debt. They did a really significant debt for equity swap, issued preferred stock, and poof, $25 million in debt gone. Then they took a massive chunk of that new cash, $45 million, to prepay their senior secured term loan.
And that move, that just drastically cuts their recurring debt payments, which is, I mean, that's everything for a growth company trying to get profitable. But the real flexibility came from the covenant reset, didn't it?
Absolutely. The term loan amendment reset their minimum liquidity covenant all the way down to just $5 million.
Wow.
So if you, the investor, look back 6 months, the company was totally focused on capital preservation, just managing cash to meet debt payments and, stay alive.
Right. Survival mode.
Now, with $90 million in the bank and that covenant floor at $5 million, they've bought themselves freedom. They can finally shift from survival to strategic capital deployment.
So they're not on a crisis footing anymore, which suggests they can now invest, maybe aggressively build up inventory for that rising OEM demand, or even accelerate some R&D.
It's a completely different financial posture. The foundation is fixed. So now the question becomes, is the operational engine strong enough to support this new structure? And Q3 2025, that gives us the answer.
It was a huge inflection point.
A definitive one.
Okay, let's break down those Q3 numbers for you. Net sales re-accelerated, and I mean sharply, to almost $16 million.
15.97 to be exact.
Right. That's a 25.5% increase year over year. And what makes that so explosive is the context. In the 12 months before that, revenue was actually declining by over 21%.
It's an incredible turnaround.
Going from a steep decline to 25% growth in a single quarter. That tells you the operational strategy is finally getting some serious traction.
It confirms the momentum. And we have to look at the main driver there, OEM sales, original equipment manufacturer.
Okay.
That channel grew 44.3% year over year in Q3. This is the difference between selling a product to a consumer versus, integrating your product right into a manufacturer's assembly line.
And that's where the competitive mode is built, right?
Yeah.
In that integration. This growth came from new customer deals, and they specifically called out their relationship with Thor Industries.
And its affiliates, yeah, which are just massive players in the RV market.
So this brings up an interesting point for you to consider, though. When you get that much leverage from just one or two big partners, you get scale, sure, but you also take on concentration risk.
That's a fair challenge. I mean, if Feor or another huge OEM partner suddenly hits headwinds, let's say the RV market cools off, or worse, they change their supply strategy.
Couldn't that just wipe out all these hard-won gains?
It's absolutely the #1 execution risk right now.
Yeah.
But the company mitigates this, I think, through its competitive position. They're not selling a generic battery. They're selling an integrated power system.
Okay, explain that.
So once a big RV maker like Feor integrates Dragonfly's proprietary battery management system, the software, the charging algorithm, all of it, into their vehicle line, switching suppliers becomes incredibly expensive and technically very challenging.
I see. So the moat isn't just the battery cell itself, it's the intelligence. It's the software that basically locks the customer into the Dragonfly ecosystem. That makes sense.
And you can see that integration paying off in the efficiency numbers. Look at profitability metrics. Gross margin expanded dramatically.
How much?
It went up by 710 basis points. It hit 29.7% in Q3.
And for anyone listening who doesn't live and breathe financial reports, a basis point is just 0.01%. So a 710 basis point jump means their margin grew by 7.1 percentage points.
It's a colossal surge. It shows huge improvement in operational efficiency and, better cost management as their volume scales up.
That margin expansion is what drives the long-term value.
But it is. We have to stay balanced, though. While their adjusted EBITDA, that's earnings before interest, taxes, depreciation, amortization, it did improve a lot.
That number strips out a lot of the restructuring noise.
Right. So that loss narrowed to about $2.1 million, but the official GAAP net loss actually widened to $11.1 million.
And that's because of all those one-time investments and restructuring costs we talked about. They're pouring cash back into growth. So, okay, real GAAP profitability is still the goal, but the direction of the operating margins is overwhelmingly positive.
So now let's zoom out a bit. What is it that truly differentiates Dragonfly Energy? They specialize in deep cycle lithium-ion power systems for very specific high-value markets: RVs, marine, solar, and off-grid.
These are all niches where, failure is not an option. A boat, an RV, or remote solar setup. They need power that's hyper-reliable.
Precisely. And they capitalize on that reliability need through vertical integration. They don't just, buy some commodity cells and slap them together. They offer the full system: the cells, chargers, proprietary software, the monitoring systems.
So they control performance end-to-end.
And their brand recognition in those high-end RV and marine circles is a direct result of that complete reliable approach.
And if you pull the camera back even further, you see they're just riding this huge macro wave. The whole thesis here is supported by the global shift to electrification and that growing need for off-grid power.
Whether it's for remote work, leisure, residential backup, that trend provides a huge foundational demand for what they do.
Which means their success really comes down to execution. Can they keep capturing market share with these big OEM wins?
Which leads us to the critical question. What catalysts are coming up? What should you be watching in the next, say, 3 to 6 months?
Okay. There are 4 key scheduled events on the calendar. First up, December 31st, 2025. That's a financial checkpoint. Is the due date for the first cash interest payment on that newly reduced term loan. It's a simple real-world test of their liquidity management. If that goes smoothly, it just affirms their stability.
And then you have to factor in the technical flows from the market itself. In December and then again in February, you've got ETF rebalancing reviews, S&P Dow Jones quarterly rebalancing. Now that Dragonfly Energy is compliant again, these technical events can actually influence institutional demand. Some funds might be forced to buy the stock just to match their indexes.
The next big data point is January 10th, 2026. That's when we expect preliminary Q4 earnings guidance.
The expectation now is for continued sales outperformance and an even narrower adjusted EBITDA loss. But the market's going to react to the specifics. If that guidance is way better than expected, you could see a sharp move.
And just a few days later, January 15th is the 13F deadline. For anyone new to this, 13Fs are filings that show what large institutional investors own.
Yes. And since the company just raised $90 million, this filing is going to be crucial. It'll show us who bought into that raise. Did major hedge funds take big positions? Their confidence or lack of it can be a huge catalyst.
Okay, so beyond those scheduled events, there are the speculative ones, the rumors that often drive the wildest price moves. What's the chatter right now?
Well, the most immediate speculation, and this comes right out of that Q3 success with Thor, is expanded OEM partnerships.
More deals like that one.
Exactly. Rumors are floating around about new or deeper deals in RV or marine, maybe even a big partnership with a traditional auto supplier looking to get into specialty vehicles. A new contract like that would immediately confirm their order pipeline.
And given their focus on their own tech, I'm sure there are technology rumors too.
Always. There's persistent speculation about a next-gen battery technology breakthrough. If they were to announce a big improvement in, say, energy density or charging speed, something that really leverages their vertical integration, it would be a fundamental game changer.
I also hear some chatter about them expanding outside of just RVs and boats.
Yes, there are unconfirmed reports about them accelerating development of a residential solar battery product line, maybe debuting in the first half of 2026.
Tapping into the home energy storage market would be huge.
It would open up a completely new revenue stream and, importantly, diversify their risk away from the RV sector. And, of course, there's always the ongoing chatter about strategic M&A.
Either them buying someone, or maybe them getting bought by a bigger utility or energy player.
Exactly. That M&A chatter just confirms that the market sees the value locked up in their IP and their existing sales channels, even before they hit consistent profitability.
Let's tie this all back to the charts for a second, because the technicals have really been reflecting this whole corporate turnaround. I mean, prices just soared from its yearly lows of around 15 cents.
Hmm.
And it's now trading well above both its 50-day and 200-day moving averages.
And that is the technical definition of a positive medium-term trend reversal. For traders, the consensus right now points to a pretty clear short-term bias based on that momentum. The volume has been there too, which suggests institutional money is coming back in.
But, and this is a big but, you have to be aware that this is a turnaround story. It comes with serious risk. The stock has incredibly high weekly volatility. We're talking over 41%.
Yeah, this is not a low-stress investment. That volatility means high risk, but it also means high potential for gain if these catalysts hit.
So if we pull it all together, the outlook is the Q3 results and the balance sheet fix feel like a decisive inflection point.
For sure. The short-term existential risk is, I would say, largely gone.
So for a near-term momentum trader, this looks pretty attractive around those earnings dates and any partnership news. Analyst targets are projecting some serious upside, from maybe $1.50 up to $2.25. That suggests a huge move is possible if they keep executing.
And for the longer-term investor, this name offers really compelling leverage to that whole electrification trend. If the company can successfully convert these new OEM wins into recurring, high-volume revenue, and if they deliver on new tech, the value creation potential is enormous.
Provided they manage that concentration risk and execution risk.
Provided they manage the risk.
The story here really hinges on converting that massive capital raise into sustained sales growth and finally pushing that EBITDA into the green, proving that the Q3 margin expansion wasn't just a fluke. Keep an eye on those OEM announcements.
Absolutely. For anyone seeking exposure to that structural growth in the electrification space, especially in specialty vehicles and storage, this is a name that offers serious leverage, provided the execution risk is managed.
That's it for today's analysis. If you enjoyed this conversation, please hit that subscribe button, leave a like, and comment below to support our look into the markets.